Hi, everyone, and welcome. Thank you for joining me here today. What we're going to talk about today is the changes in the world that we live in, whereby now something like 65% of American families do actually live in a home that they own. And that number is even higher when we're talking about college educated families. So, um, as a student at Duke or as anyone at Duke, there is a good chance that you will at some point own a home. You might like to have a good understanding of how banks and other lenders make decisions about whether or not to give you a mortgage. And I'm just going to pause there for a second and see if there are any questions. Okay, let's return to the presentation. So here's how mortgages work. Let's just have a quick introduction to those. In the United States, the vast majority of mortgages that are issued are for 30 years. Okay, so if you're going to take out a mortgage loan, you would go to your bank or other mortgage lender. You would give them all sorts of information that we're going to talk about in a minute, and they will tell you at what interest rate you can borrow money for this mortgage. But standard practice is that the mortgage lasts for 30 years and also that you will make monthly payments on that mortgage. And the reason most mortgage lenders require their borrowers to make monthly payments is to align those payments with most people's typical salary payments. Most people in the US are paid on a monthly basis. So the lender simply sets up an arrangement with your bank whereby each month when your pay comes in, the amount that you're due on the mortgage automatically gets taken back out. Now, the monthly payments that you're making on that mortgage are not just interest payments. What's interesting about mortgage loans and certain other types of loans to individuals is they're called amortizing loans. And amortizing in this context means that every monthly payment that you make, some of that payment is going towards interest on the loan, and some of it is actually going towards paying down the principal. The principal is the original loan balance. It's the amount that you initially borrowed. So let's look at an example with some real numbers to help us see how this works. Let's suppose you have gone to the bank to ask for money to borrow to buy a house. And suppose the price of the house is $280,000. Now, most banks will expect you to put some of that money down yourself, usually a fairly small amount between, say, 5 and 20% of the entire cost of the house. They would expect you to have saved some of that. So in this case, with a house that's going to cost $280,000, and with your saved down payment of, let's say, $30,000, the loan that you're asking for is then $250,000. So between the loan and the down payment, you will be able to pay the entire cost of buying the house. And let's assume for the moment that the interest that they're quoting you on this loan is 3.5%. Now, there's a formula that we can use that based on the size of the loan, in this case 250,000, and the interest rate, and knowing that it's for 30 years, there's a formula that we use that determines, okay, what is the monthly payment amount going to be so that if you make that monthly payment every month over the entire 30 years of the loan, that will pay down both the interest and the principal over the life of the loan and will cover the entire cost of the mortgage. So if you were to keep that home and that mortgage for a full 30 years, you'd pay $1,122 every month for 30 years, and then you'd have paid off the entire mortgage. Let's see how this looks on a graph. So what I've got here on the horizontal axis is I have months, okay? Here's a 30-year mortgage, which is 360 months. 30 times 12 is 360. And on the vertical axis, I've got the balance of the loan. And what I'm showing you here is that balance goes down over time. And here's why. We start at month 0 with that loan of $250,000. But as I mentioned earlier, each month, some of the money that you're paying into the bank, some of that $1,122 each month, some of it is actually paying down the loan balance itself. It's reducing the amount you owe from $250,000 to, over time, if you keep the mortgage for the entire 30 years, all the way down to a remaining balance of 0. At the same time, your monthly payments are also making interest payments. Now, suppose that you didn't keep the house for the full 30 years. Most people, in fact, don't. People tend to, in the US, especially in cities, but in other areas as well, people tend to move more often than that. So if you have a mortgage on your house, and let's say after 16 years you decide to move house, now you will have to pay off the remaining balance on the loan, but of course you'll be selling the house, and that will be giving you a large lump sum that will enable you to do that. So if you decide to move after 16 years, we can use that graph. So 16 years is 192 months. Using this graph, we look over this orange dashed line to the vertical axis, and we see that after 16 years, the loan balance has gone down to $150,000. So when you sell that home, $150,000 of that money will go to the bank to pay off the remaining loan balance, and the rest of it is yours. So when you have a mortgage, over time, you're starting to own more and more of the house yourself. Okay, now let's look at something scary that's happening with interest rates these days. In the previous example, we were looking at an interest rate of 3.5%. And in fact, many people could get a loan for that amount with that interest up until, say, 18 months ago. Over the last 18 months to 2 years, we have seen interest rates go up a lot. They've come down a little bit from the highs, but interest rates are generally now quite a bit higher. So if you were going to take out a mortgage today, it's more likely that the lender would offer you an interest rate of something closer to 6.2%, which is what you can see here on screen. Now, unfortunately, a higher interest rate, even on the same loan amount, results, of course, in a greater monthly payment. In this example, if we have a mortgage at 6.2%, your monthly payment will now be $1,531 each month. That's $409 more every month that would come out of your paycheck to service that mortgage. And just as a quick aside, that may be why, even though in Durham and many other areas of the US, we haven't seen house prices come down very much in recent months, but what we have seen is fewer sales in recent months. Just the fact that interest rates have gone up have made it that much harder for people to decide that they can afford mortgages, because every month at 6.2%, there's that much more, $400 more every month than when we were in an environment where you could get a mortgage at 3.5%. So if you're wondering why the last few months have seen fewer house sales, this is a part of the reason. It's just become more expensive to take out a mortgage. Okay, now let's come back to the point of view of the lender who's lending you that $250,000 or however much to buy the house that you want to buy. The lender's primary concern is that you will make your monthly payments every month for as long as you have that loan, whether that's 30 years or less time than that because you sell the house. In either case, the lender wants to know that you can make those payments. Now, some borrowers look stronger than others, and even just the fact that we moved from a world of 3.5% mortgage rates to 6.2% mortgage rates over the last year and a half or so, that already is going to make lenders more cautious, because for any given person, their ability to pay $1,100 a month is going to be a little bit better than their ability to pay something closer than $1,500 a month. The last thing the mortgage lender wants to do is have its borrowers be delinquent. Delinquent simply means you stop making the payments on your loan. And that's exactly what the lender wants to avoid. So let's see what the lender does to think about whether to offer you a mortgage loan. So I mentioned earlier, if you go to the bank to get a loan, they're going to ask you a bunch of questions. They're going to start with what is your annual income? How much have you saved for the down payment? And also something called a credit score. If you're not familiar with credit scores, this is a system that's used in the US. The most common credit scoring system is called FICO, or the initials FICO. It's usually referred to just as FICO. And anybody who has had any type of loan of any sort in the US has a FICO score. And this includes credit cards. If you have a credit card or multiple credit cards, your performance in terms of making payments on that card at the end of the month, if you owe money, that feeds into your credit score. If you've rented an apartment, your ability to make your rental payments on time, that feeds into your credit score. Pretty much these days, most of what we do as adults when we interact with financial institutions are going to be doing things that affect their FICO score. And again, I'm going to stop there for a moment just to see if there are any questions. So I see there is a question about managing long-term amortization of assets. I'm not quite sure what that question is asking. This is the amortization that we're talking about here may be different from from what you're thinking about in terms of amortizing assets over their asset life. Loan amortization simply means that every month when you make a payment, some of the money from that payment is going towards interest and some towards principal. That's separate from the quality of the house or other asset that you're thinking about. How will the value of that asset change over time? That's a different type of amortization. All right, so let's carry on. As I said, they're going to ask you, the lender is going to ask you what's your annual income, your down payment amount, your credit score, which we've touched on, comes from your credit behavior for as long as you've had interaction with financial institutions. They might also ask you or they will also ask you three other questions, quite likely. And those are age, gender, and ethnicity. And we might be wondering why, in particular, gender and ethnicity, why lenders are asking that question. Why should it make any difference? And that's kind of what we're going to explore a little bit today. And we're going to explore that with reference to gender. And we're going to see whether there would be ways to determine whether, even in this computerized world, if lenders are more inclined to give loans to men than women, are computers potentially doing the same thing? And then even more than that, if that is the case, if lenders are more inclined to give loans to women than to men than women, is that fair? Is that acceptable on some basis? So let's talk about that. So we discussed these three important factors, and clearly the higher your income, the higher your down payment, and the higher your credit score, every one of those unambiguously makes it easier for the lender to lend you money. But let's move on to these more ambiguous characteristics and why they might affect you. So, for example, let's suppose that there was a history before all of these decisions were made on computers. Let us suppose that banks and other lenders, for whatever reason, and we'll come back to the reason later, were more inclined to give a man a mortgage than a woman who had all the same characteristics, same income, same annual income, same down payment, same credit score, same age, and yet let's query, perhaps there was a history of lenders being more willing to give loans to men versus women. And so the question here is, how likely is it that this Jane Doe with these exact characteristics, the same as perhaps another man who has all the same characteristics, but was Jane Doe less likely to be approved? So there are two types of possible bias here. One is a bias where simply lenders felt like men were safer bets than women when it came to mortgages. I think that kind of bias, we would all agree, is inappropriate. The decision making that should happen when banks decide whether to give people loans should be based on characteristics that have genuinely been shown to make a difference. Right? And the first three of those, your income, your down payment amount, and so on, your credit score, those are obvious and explicable characteristics. But why should, whether you're a man or a woman, make a difference? And what we want to understand is, how do we assess this, and how do we determine whether there is some unfair bias in this system? Okay? So what we want to do then is determine whether, if women are being given mortgages less often than men, even when they have exactly the same financial and so on statistics, whether that bias is fair or unfair. Now, what we can't do is look at all the men and the women who've been denied mortgages and see if we can determine whether there's fairness involved, because if they've been denied mortgages, we can't assess how well they would have paid on those mortgages. So what we need to do is look at a long history of men and women who have been given mortgages, and then look at their delinquency performance. Look at whether, for men and women who have the same financial characteristics, whether those women have been more inclined to be delinquent than men. So again, the question that we're asking is, if we take all of these, a long history of men and women who have been given mortgages, and put them into buckets, put them into groups, men and women who have the same income, who've provided the same down payment, who have the same credit score, are the men or the women more likely to be delinquent? If, in fact, we find from the data that across men and women who have the same credit score, same income, same down payment, if we find that, in fact, men or that women are more delinquent than men, or in fact that men are more delinquent than women, in either case, that would be something that we call a statistical bias. There could be some reason why historically women have been less good at making their mortgage payments, or we might find the data sends us the other way and find that men have been less good at making their mortgage payments. But the important thing here is that we need to find out whether that bias exists. And we can do that by looking at hundreds of thousands of records that have been issued as mortgages in the past and take a look at the data. So I'm going to take a quick aside here for a moment, and we're going to talk about a model that we're going to use that will enable us to analyze the data in a statistical fashion. And this is a model called the regression model. So it's a very commonly used statistical tool, and it's very helpful at helping us to look at relationships between one feature and another feature. So to give you some intuition about regression, in case you haven't used a regression model in the past, I'm using an example here of data that we're probably much more familiar and comfortable with, and that is people's height versus their weight. So on the horizontal axis in this picture, I've got a range of possible people's height in inches, and on the vertical, I have their possible weight in pounds. And if you look at all of these dots, every dot reflects an individual. And if we look at one of the dots and we see where that lands on the horizontal axis, jump one too quickly there. If we look at a dot, it reflects for each individual what is that person's height and what is that person's weight. Okay, so we could draw a vertical line down from any one of the dots and see what that person's height is, and then a horizontal line across to the vertical axis and see what their weight is. And as we all know, and just take for granted, height and weight are, of course, correlated. All else equal, taller people tend to be heavier. Now, this is not a perfect relationship. There are any number of other factors that go into the relationship between somebody's height and their weight. Everything from how much they exercise to how much they eat to what their metabolism is like, and dozens of other factors. But if we look at this picture, we do see that at least to some extent, as we move northeast, if you will, on the graph, we do see that there's a tendency for at the bottom left to the southwest of the graph, there are more dots, and to the top, the northeast of the graph, there are more dots. You're not seeing many people here who are shorter than most of the people in the sample, but also weigh a lot more, and nor are you seeing a lot of people who are really tall but weigh a lot less than the average. And this relationship between height and weight is something that we call correlation. And correlation is a measure of how related any two factors are. And we're doing this with height and weight because it's easy for us to think about that. If the two factors were perfectly related, if you could say every person who's this height is exactly that weight, we would talk about it being perfectly correlated. And if, in fact, height and weight went in opposite directions, and the taller people were, the less they weighed, we would say it was negatively correlated. The highest possible correlation is 100%. The lowest possible negative correlation is minus 100%. And if there's absolutely no relationship between the two factors, then we call that 0%. Now, for height and weight, it turns out that the two are about 50% correlated. That is, height provides something like 50% of the explanation for any given person's weight, with all of those other factors like, again, how much you eat, how much you exercise, your metabolism, and so on, making up the other 50%. How do I know that it's 50%? I know because of the mathematics of regression that enables me to do a couple of things. One, the mathematics enables me to draw what we call the best straight line through the data. And once again, I'm going to stop there for a moment and see whether we have any questions. Okay, and let's come back to the presentation. So, as I said, there's some mathematics that a statistician can do, or in fact an Excel spreadsheet can do, that finds what we call this best straight line. And this is the dark orange-red line that you see cutting right across the graph. And what that line is, it's the line that minimizes the distance of all of those dots from the straight line. So if you could find the single line where all of the vertical distances, like these two orange arrows here, we've got the distance of one dot from the line down towards the bottom, we've got the distance of another dot to the line. If we sum all of those vertical distances of the dots to this line, we will find that that sum is smallest with exactly this straight line. And again, there's a statistical technique that enables us to do that. Another thing that this regression analysis enables us to do, which is also helpful, is to determine the extent of the correlation. I mentioned earlier that for this particular picture of height versus weight, the relationship between height and weight, which is something we call the R squared, is about 50%. And again, what that means is something like 50% of what drives somebody's weight is related to their height, and then there are a ton of other factors. And the other thing that we get from a regression analysis, which you see here on screen, is a formula for the straight line. So y here on the formula on screen, the y is the vertical axis, and the x is the horizontal axis. So what this formula here is telling us is that if I know somebody's height in inches, that's my x. If I multiply that by 5.49, and then I subtract 222.5, that will give me an estimate of that person's weight. Now, to be really clear, again, this is the estimate that's driven by that straight line. As we see on here, most of the dots don't lie perfectly on the line, and by the same token, most people's weight will not directly be the y that we calculate when we apply this formula to their height. But it gives us an estimate. If the R squared is reasonably high, like 50%, it can give us some intuition about, okay, if this is your height, I'll apply that formula, and in most cases, I'll probably come fairly close to guesstimating what your weight is. And this is how we use a regression model. Okay, now we're going to jump back to mortgages. And I have another graph to show you. And this is a graph that is based on mortgage delinquencies, that is, people failing to make their mortgage payments, between 1991 and 2006. And what we're estimating here is mortgage delinquencies, that is the likelihood of people starting to fail to make their mortgage payments, versus where interest rates were 6 months earlier. So why am I looking at mortgage rates 6 months earlier? Let's put a story around this. Let's say our friend Peter goes and gets a mortgage, and his interest rate is 5%, and he believes, and the bank believes, that he's going to do fine in making his monthly payments. And for the first few months, he does do fine. But he starts to discover over the first few months that it's becoming harder and harder with his monthly mortgage payments to manage all of his other expenses as well. So he is one of the unfortunate people who finds that they can't manage their mortgage payments. He does become delinquent, but it's not going to happen in month one or month two. It is more likely that that will start happening in about month 6 or a little bit longer than that. Okay, so now let's interpret what we're looking at on this graph. On the horizontal axis, we've got dates from July 2001 to July 2006. Okay, if you look at the blue line that runs sort of downhill from the left-hand side, comes back down and goes up again, that blue line is the percentage of delinquencies of all of the mortgages in the pool of mortgages that we're analyzing here. We've got thousands of them, okay? All of the quantity of delinquencies over the course of that period of time from July 1991 to July 2006. So as you can see, there are periods of time when delinquencies were higher. There was a higher percentage of delinquencies early on in July 1991 than there was, for example, in January 2005. And we're going to see why that's the case in a minute. But the level of delinquencies that we're measuring, the level of delinquencies that we're measuring is shown on this vertical axis on the right-hand side. Now, what I've also shown on this graph is where were mortgage rates 6 months earlier. And on the left-hand axis, this axis shows us where the interest rates were on mortgages 6 months before these delinquencies started to happen. So the purple line shows that when mortgage rates were high, as we see on the left-hand axis, like up at around 10%, these are the mortgage rates that we had are shown on the purple line. And what we can see here is that as mortgage rates go down, because from the left-hand side, as we move towards the right, we are seeing mortgage rates go down, at least till January 1999. And at the same time, we're also seeing the blue line, the delinquencies, go down. And then as we get to Jan 2005 and start seeing mortgage rates go up again, we see delinquencies start to go up. So let's just double check that everybody is fully on board with what we're looking at here. We're looking at July 2003. And if we go up to the mortgage rates line, the purple one, and at July 2003, we look over at the vertical axis to the left. That's telling us that 6 months prior to July 2003, mortgage rates were at around 6%. Okay? Now, at that same time, July 2003, mortgage delinquencies were at about 1.8% of all mortgages. So in fact, delinquencies were pretty low. Only fewer than 2 people in 100 were delinquent on their mortgages at that time. As you can tell, if we go over to July 1991 or July 1992, we can see that both mortgage rates were higher 6 months earlier, and therefore delinquencies were higher. So what are we seeing here? We're seeing a relationship, we're seeing a strong relationship between mortgage delinquencies and the rates that people were getting on their mortgages 6 months earlier. The two lines lie very close together and seem to move very much in the same direction. There's the odd weird spike sort of around July 1995 or so. But in general, as mortgage rates go down, delinquencies go down as well. And of course, this completely makes sense because we saw earlier, the higher the interest rate, all else equal, the more money you're having to take out of your paycheck every month. And therefore, all else equal, the harder it's going to be to keep up with your mortgage payments. Okay. Now we're going to bring that analysis into the analysis that I showed you earlier of a regression model. So what we're looking at here on this graph, on the horizontal, we have the 6-month prior mortgage rate percentage. So now we're not looking over time. We're looking at relationships between 6-month earlier mortgage rates and, on the vertical axis, delinquencies. So let's make sure we're comfortable reading this particular graph. If the best straight line, let's look at one of the dots and just think about what that's telling us. So here again, an individual dot is an observation at a moment in time of what was the mortgage rate 6 months prior. So if you look at a dot and just drop a line down to the horizontal axis, you can read off what was the mortgage rate 6 months prior. And if you go back up to the dot and go across to the vertical axis, that will tell you for that mortgage rate what the percentage of delinquencies were. And then, as before, we have a dashed line which is reflecting the best straight line of all of these dots. Again, it's the line that minimizes the distance between each dot and the straight line. So if we added up the sum of all of those distances, we would have the smallest possible sum. This is the line that gets as close as possible to all of the dots. And it's telling us, again, what we saw in a different way on the previous graph and what, in fact, we might expect, which is that when mortgage rates go up, delinquencies tend to go up a few months later as well, because as rates go up, the monthly payments go up, and that makes it harder for people to keep up with their mortgages. And I'm going to stop there again and see if there are questions. So there's a question about digital assets and digital currencies and how that's going to change the way people borrow money. And that's a huge question, and one that you would get, I think, very different answers from different people depending on their view of the digital currency market, of the cryptocurrency market. Certainly, we're in a world where everything that we're doing financially is changing, like almost month to month. It feels like the entire area of what we call fintech or financial technology reflects all of the different ways that we now increasingly interact digitally on almost anything. I was at Twinnies, one of the coffee shops on campus, the other day, and myself, along with everybody else in the line, when we were paying for our coffee or whatever it was we were buying, some people took out a Duke card and waved it over a reader. Most people took out a phone, as I did, and waved it over a reader. And one of my colleagues actually took out a $20 note. And I looked at him and I teased him. I said, "You have to be the only person in line here today who's paying in cash. None of us pay in cash." That in itself is a huge change. but the changes aren't going to stop happening anytime soon. We are in a very, cuspy, exciting period where financial technology is concerned, and we're going to continue to see changes, some of which we might be able to guess and some of which we could probably never guess, in the way we interact with everything that we do financially. And, one of the simplest of those is most of us just don't need to carry cash anymore. And that's been a huge change just in the last 5 years, and one of any number of changes that we've been seeing. All right, so let's come back and finish off what we're going to do with this regression model. Turns out that for this particular regression, the R squared, that statistic I mentioned earlier, is about 75%. And what that means is 75% of the explanation for why the people who were defaulting were delinquent on their mortgages, 75% of the explanation is the size of the interest rate that they were given. And again, we can tell that because most of the dots do seem to lie pretty close to the straight line, more so than we saw on the height and weight chart, actually. There's a much stronger relationship here. As interest rates go up, defaults go up. It's nice to notice, by the way, that even when interest rates were pretty high, delinquencies, people defaulting on their mortgages, was still less than 4 people per 100. I mean, the banks are pretty careful about who they give mortgages to, and individuals are usually pretty sensible about how much they can really afford to come out each month from their paycheck. So only a relatively small number of people are delinquent, but certainly that goes up in an environment where interest rates go up. So let's bring all this back to the statistical question. And the statistical question is this: how do we determine then whether, if we observe that women are being denied mortgages more often than men, how do we determine whether that statistical bias is fair or not fair? And the way we would do it is by looking at a chart like this. And what I would do is I would go in and I would separate out, across my huge pool of mortgage data and delinquencies, I would separate it out into a bucket with men and a bucket with women, okay? And I would do this analysis separately for the men and the women. And I would say, okay, it seems like interest rates 6 months earlier, or mortgage rates 6 months earlier, are a pretty good predictor. Let's see how that predictor works on a full pool with women only who got mortgages, what proportion of them were delinquent, versus looking just at the men who were given mortgages and what proportion of them were delinquent. And if we see that women were less likely to be delinquent, their straight line is a little bit different. If they were less likely to be delinquent than the men who'd been given mortgages, that would be an indication to us that there was unfair bias. We should expect to see men and women being delinquent at exactly the same rates across this long period of time with lots of different mortgage rates. And if they aren't, if the women are less delinquent on average than the men, that would suggest that there was bias in women less often being approved for mortgages than men. And the final point that I want to make brings us back right to one of the very first things I said, which is, if all of this is being done on a computer these days and the lender at the bank is not making a personal decision, he's just plugging your numbers into a computer and the computer says, should we give this person a mortgage? You would think that that kind of bias, if it existed, would no longer apply. But what we have to remember is that the models inside the computers that are determining who to give mortgages to, those models are what we call trained on historic data. So when those models, those algorithms were first built to determine, should we give this person a mortgage based on all of those characteristics? Should we give that person a mortgage? A whole load of existing mortgage information was plugged in, and the model was trained by looking at that data. So if there had been historic bias in women being less likely to be given mortgages than men, the model was trained on that basis. And it's possible that its algorithm would still then be less likely to give a woman a mortgage, even though she had exactly the same financial characteristics as a man. So it would still be of interest to go in and look at this data and see whether the models that are now determining who get mortgages have in fact had that any of that type of bias, whether any of that type of bias still exists. And we would be able to determine that using this type of model. So I shall wrap it up there. And I hope you found this useful and interesting. And it was a pleasure putting this together and sharing this with everybody. And thank you so much for watching the presentation.